Okay, let's get started. Thank you everyone for making time to come for this webinar. I'm John, and today our speakers will be Ashton and Hilda. So joining us for this webinar will be our investment analyst Ashton Leo, who was a Singapore Management University SMU graduate with experience working in Bank of Singapore and JP Morgan, and our relationship manager at Kristal.AI, Hilda Tan, who heads up the channel partnership and manages portfolio for existing and new clients. So in this webinar structure, you can use the Q&A tool to ask any question anytime. If you have any other questions, you can email us at support@Kristal.AI. This webinar will be recorded and uploaded to our YouTube channel, which I'll explain at the end of the webinar. So now let me hand my time to Hilda.
Thanks, John. So 2020 has been an extremely interesting year for a lot of investors. At Kristal, we also saw many new investors starting their first investment. If I remember correctly, the last time where everyone was eager to start investing was during the Bitcoin rush in 2017. So everyone seems to be wondering if the market will rally or if there will be a long-awaited correction. Either way, it suggests investors will definitely be experiencing volatility in their portfolio. So what exactly does portfolio volatility mean?
Thank you, John, for the introduction, and thank you, Hilda, for the very timely question. So yes, the market went through quite the ride over the past few months, and these market swings that we've witnessed are what we term as volatility. And by definition, volatility actually measures the standard deviation between the market returns. But most of us, this volatility manifests itself in terms of that sinking feeling of watching your portfolio go down, which then leads us to the fear of volatility, and this ultimately leads to an underinvestment as a whole. And this is either because investors end up having to exit their positions to meet short-term liquidity needs, or it's just uncertain as to how markets would play out. In 2020 alone, we have observed two highs and a near 2008 market crash. And I'm sure during a March crash, most of our portfolios were stained red. Now, that is not something that one could imagine to have been easy to weather through. So essentially, the point we're trying to make here is that there is a world of difference between understanding what volatility is statistically and experiencing volatility as investors. That's why it is crucial for investors like us to understand how to manage this and invest accordingly during these periods.
Definitely. So during the March crash, I had conversations with clients who were unsure if they should sell off, hold on, or reinvest in the market. So how can investors look for the right decisions during volatile periods?
Right. So there are many ways you can invest during uncertainty. And I'm sure we've heard of those one-hit wonders whereby you invest in just one growth stock and then it gives you 300% ROI. However, only the successful one makes the headlines and are publicized, and the ones that lost everything are kept in the dark. Thus, it is important to see how we can use diversification to help us manage portfolio volatility. So now let's do a quick poll, right, to see how our audience today actually invest during volatile periods. John?
Okay, I've launched a poll, so just do vote, and we'll close the poll later, and we'll reflect the results in just a short bit. Okay, so let me just end the poll. Thanks everyone for participating. Yep, so interestingly, systematic investment planning is the most popular results is given in a poll. So let me just hand my time to Ashton.
Right. So as you can see from the results, that there are two popular ways that investors actually invest during volatile periods. Systematic investment planning, which is the SIP, means that you can invest in tranches in your portfolio, whereas lump sum just means that you put in your investment one shot on the get-go. Also, aside from trying to implement your investment strategy through an SIP or lump sum, there is another form of way you can manage volatility, and that is through diversification. And diversification itself plays an important role in helping us manage this portfolio volatility and how we actually sit through these investment periods.
Thanks, Ashton. So which method would show a better return for investors?
Oh, that's a great question, right? So what we have done at Kristal is try to see how these different investment strategies actually plays out in different simulated market conditions. So here, we have done a simulation based on 3 market scenarios to see if the SIP is actually better than lump sum investing approach. So in this simulation, we will be using the State Street's flagship S&P 500 ETF, termed as the SPY, as you're going to be hearing a lot about, as a proxy for the portfolio. Now, in the first scenario, it is simulated that the SPY actually goes down to $280 by month 4 and rise up subsequently to $360 by month 12. Now, the monthly NAV that you're seeing here means that you're investing in the SPY on a monthly basis in 12 equal tranches. Now, we observed that in scenario 1, the quarterly tranche actually performed the best. Now, moving on to the second scenario, in this scenario, we are simulating that the SPY goes all the way down to $230 by month 12. So this is a simulation for a bear market. And from this, we observed that if you had a lump sum investment strategy, that would have taken the largest hit, while the monthly SIP would have seen the least drawdown. In the final scenario, where SPY goes down and subsequently comes back up to where it starts out, you can see that the monthly NAV actually experiences the most gain as compared to the lump sum. And this is because adopting this strategy allows you to dollar cost average down when the market is down. And then as a result, you get to capture this upside performance subsequently. But you can imagine, right, in this market scenario, that for investors who have been shaken by the initial decline and have decided to sit out of investing as a whole, now this leads to underinvestment, and that if you're the investor who have done this, you would have missed out the subsequent recovery. Moving on, when we look at these different simulated conditions and how broad market scenarios tend to play out over the past 20 years, you see that having some form of SIP and tranching your investment accordingly actually provides for a better and more resilient performance as compared to just deploying your asset in one shot. Looking at it from a risk-reward perspective, I think the notable point here is that the SIP is definitely a better and more robust strategy as to how one can deploy his investment.
But in a bull market, wouldn't investing lump sum in the market bottom see more attractive returns than a planned investment?
Well, indeed. I mean, if you have a crystal ball, then lump sum investing during a bull market would make a lot of sense. But given the current market volatility and that we don't really have a clear sense as to whether the market is likely to break out significantly from where it is today or go down, I think it is best to approach this from a risk-reward perspective, right? That you have a more disciplined approach to how you invest systematically. And this is how SIP actually comes into play.
Okay, but so aside from SIP, you mentioned about diversification earlier on. What are some examples and benefits of diversification?
Yes, Hilda. So to diversify simply means to spread your eggs out into various baskets, right? And on a portfolio level, that traditionally means an investor allocates their assets across equities, fixed income, and commodities, right? Spreading out your risk helps mitigate the impact of idiosyncratic risks. That means that if one or two companies or asset goes bust, this does not drag your whole entire portfolio with it. Now, doing so has actually proven to protect investors from severe drawdowns and ensure a quick recovery in volatile markets.
What is your view on a 100% equity portfolio? Because I've heard of stories that investors get massive gains just by investing in equities such as Zoom and Tesla.
Right, that is an excellent question. So you probably could invest in a 100% equity portfolio, right? But market timing in this kind of market condition whereby we're seeing heightened levels of volatility, this is going to be something that is hard to get right? And it's going to be also equally hard to sit through volatile investments. So if I could direct your attention to these charts that we're showing right now, you will be able to see the performance difference between holding 100% stock versus having some form of diversification across both stocks and bonds. 100% stock portfolio took the deepest hit and the longest period to recover its initial value after the 2008 Great Financial Crisis. And on the other hand, a 60-40 stock bond portfolio, as you can see on the chart in the light blue line, on a relative basis, it took the least hit and it recovered its initial value in the fastest time. So on this note, I think perhaps you could do another poll just to find out if our audience actually have any allocation currently towards fixed income.
Okay, great. I'm going to close the poll soon. Thanks everybody for participating in the poll. So interestingly, there's about 60-40, 60% of people who have actually fixed income in their portfolio and a notable 40% of people who actually do not have fixed income in their portfolio. Now, let me hand my time to Ashton.
Great. Thank you for submitting your feedback. We appreciate that a lot. Thank you for submitting your answers. We do appreciate it a lot. So in the past, what we found is that retail investors often found it difficult to achieve portfolio diversification because of the mismatch between the minimum investment size that is required of fixed income investment versus the amount that we as retail investors can actually afford to put in through an SIP, right? So the minimum size on a traditional corporate bond probably would cost you around 50 to 200K in minimum investment size. However, with the emergence of ETFs on both the equities and fixed income front, retail investors like us now have better accessibility to diversification through the FI ETFs. So now, for example, you can gain access to the US investment grade corporate bonds ETF through LQD ETF. Now, this is an investment grade corporate bond ETF that's managed by iShares BlackRock, and you can get it for as cheap as its current price of $133. And if you would like to invest in the broader equities market, so let's say in the US, S&P 500, traditionally that means you probably will have to fork out $3,000 because that's where the index stands. But now, State Street actually provides for the SPY ETF, which is the SPY US, that actually trading for 1/10 the price. So that is USD $300.
It's great how investors can access fixed income ETFs so easily nowadays instead of purchasing an actual bond. So what is your recommendation to an investor who is new to fixed income ETF and doesn't know which to choose?
Oh yes, I mean, certainly if you do have a view on a particular fixed income ETF already, then you could execute it and trade it out on your own. However, for most investors who don't have the time to look through the entire fixed income universe to find one that actually suits their risk return appetite, then what we're doing here at Kristal actually would give you that value proposition, right? Because on Kristal platform, we actually give you access to affordable, diversified portfolio solutions so that investors like you can achieve diversification in a cost-efficient manner. So one solution that many of our clients love is the AutoPilot Kristal. This is one of our flagship crystals. As the name suggests, this is an algo-driven crystal which suits investors who prefer a more hands-off approach while enjoying the benefits of a fully managed portfolio. More importantly, this crystal actually provides for a meaningful diversification across equities, fixed income, and commodity space. But at the moment, this Kristal strategy actually is invested in the following 60-40 stock bond allocation. Now, to date, the AutoPilot Kristal has achieved close to 10% per annum, right? So on an annualized basis, it's an average of 10% growth. And because this portfolio encompasses both a diversification across equities and fixed income, you see that it has only seen a drawdown of 13% during the March crash, whereas the broader equities market draw down by 35%. So this is definitely an interesting crystal that provides you with the meaningful diversification if this is what you're looking for.
So if AutoPilot is suitable for investors with a higher risk profile, what is the alternative for our investors who has a lower risk appetite?
Well, I would say for investors who are seeking a diversified portfolio solution that is of a lower risk nature, then the all-weather Kristal certainly is one notable flagship solution that we have on our platform. Now, the all-weather Kristal is a more diversified crystal as compared to the AutoPilot Kristal, right? You can see on the chart here that there is an allocation towards equities, fixed income, gold, and commodities. Now, if you refer to the price performance chart on the next slide, for our all-weather crystal, you can see that during the March sell-off of 35% on the equities front, that the all-weather strategy only draw down by 7%, and it has since recovered those losses. The benchmark that we've used here is the State Street's multi-asset return ETF as a proxy. And even this proxy has seen a drawdown of 25%, whereas the all-weather crystal only saw 7% drawdown. So I hope the main message here is that we have illustrated to you the power of diversification and how it can actually protect your portfolio and manage the volatility.
Thanks, Ashton, for taking us through the strategies to manage portfolio volatility. So what should I do with my existing portfolio when I already follow an asset allocation? Should I still subscribe to the all-weather AutoPilot Kristal? Will my portfolio be over-diversified?
Well, in that case, I would say that if this is a portfolio that you had for a while now, I would assume most people have ran their own portfolios on other platforms with any other brokerages, right? That perhaps it might be timely for you as an investor to relook whether your own risk return profile is truly expressed in your portfolio. What I mean there is that as an investor, your risk return profile might have changed. And if after learning, let's say, about the all-weather crystal and seeing its performance and low volatility today, and you believe that, perhaps this is something that actually is something that I'll be more interested and comfortable investing in, then this would be a strategy that you can sit on comfortably, right? And aside from this, even if after learning about the all-weather crystal today, you're saying that you still prefer something that gives a more aggressive return, say between the range of plus 25% to minus 15%, then you could stay with the algo's recommendation on our platform towards a more aggressive approach, or whatever current portfolio strategy you're currently running towards the strategy and the objective that you're trying to achieve. So in summary, we believe that volatility is something that an investor is never going to be able to shake away in the short term, right? Because when market expectations when market results exceeds expectations, you're going to see that upsurge. And when it disappoints, you're going to have that short-term downside volatility, right? So volatility on the short term, it is going to always exist. But how are we going to manage this? Today we've learned that you can manage this through the SIP to navigate safely across uncertain market conditions. And also to complement that strategy, it is also important that we diversify across asset classes so that we achieve steady and consistent portfolio growth without these mini heart attacks when the broader market drawdowns. Thank you.
All right, thanks a lot, Ashton. So before we get into the Q&A, so we'll do just a last poll to understand, like, after listening from Ashton and Hilda about how you can diversify your portfolio, so just want to understand what will you actually do? So just launch a short poll. Okay, let me just a bit more. The results are actually very interesting. I'll just share with you guys later to take a look. So about how our audience, the common consensus, and what what most of us actually think. Okay, we'll just stop it in a few more seconds. All right. So yeah, so interestingly, buy more ETFs, being like equities or fixed income ETFs to diversify your portfolio, is actually a leader, followed by purchase ready-made diversified portfolios. Yeah, so that's very interesting. So let's move into the Q&A. So feel free to actually ask questions that you actually have, and can just get along with it. So one question that we got is, what about REITs? Is it fixed income or equity? So what our panelists think about that?
I think that is a popular question that we get often on webinars, right? So a REIT, by nature itself, it is a form of equity, but also it is some sort of in between, right? Because in terms of the returns and what the payout that we're getting, right, that it's a bit more consistent, like a fixed income, because the nature of REITs is that this trust, the REITs trust, right, they are mandated that they would have to issue at least 90% of the operating income towards this issuance of the payouts. So it would be equity by nature, but in terms of the payout and the yield, it might be something that tracks more closely towards fixed income.
Okay, thank you. Thank you so much, Ashton, for sharing about that. So one more question we got, interestingly, is, yeah, okay. Let me just share the screen again. Okay. Yeah, so one question we got is, what is the role of gold investment in a SIP portfolio? So any of our panelists would like to take that question?
Yes, surely. So I think besides just SIP portfolio, right, even in a conventional portfolio, gold has been that asset class that most investors actually turn to as a diversifier away from equities and fixed income, right? For good reasons, because during heightened levels of market uncertainty, investors' general sentiment is they're not too sure whether equities are going to continue to outperform, or if fixed income's valuation is overly saturated. So in those kind of circumstances, that you do see inflows back into gold as a form of investment and diversifier to kind of hedge out the overall portfolio's volatility. Thank you for the question, CY.
Okay. Okay, sorry, just looking through the questions and finding something that we can all understand and take a look at.
Okay, I think we have the third question, whereby one of our audience is asking whether diversification is always recommended. How do you come up with the right formula? And how can we avoid over diversification, right? So let's handle that step by step, okay? So diversification as much as possible, I think we think that it is recommended to reduce the overall portfolio's volatility. And how you arrive at the right formula, that really is a question as to what is the risk and return you're searching for, right? You can't be expecting 20-30% return over 20%, over like a period of like 10 years consistently, if you want to have a very defensive approach whereby you're invested, let's say 40 equities and 60 fixed income, because it just doesn't work, right? Because you want to be a bit more conservative. So in the world of investment, there is no free lunch, right? Every ounce of risk you're going to take, that is going to be translated into the return that you want to be chasing. And the right formula would then be to ask whether your investment objective is you want 10% return, 15% return, or 25% return, and what is the commensurate risk you're willing to weather through. And then this can be expressed into how your portfolio would eventually be constructed. And across asset class, I think it's hard to get over diversification, right? Because like I said, it depends on what is the risk return you want to achieve ultimately. But within an asset class, let's say within equities, right? If you are going to say you want to buy 20 different sector ETFs, right? Tech, healthcare, commodities, real estate, or energy, or this, right? You're going to buy 20 sector ETFs. Then my recommendation there would be, why not just buy the S&P 500 ETF? Because essentially that would be what you're constructing, right? So in that sense, within an asset, that could come across as a form of over diversification. So I hope this answers the question.
All right, thanks Ashton for answering that in so much detail. It was very insightful. So one question that we got was like this audience have a very positive view on technology stocks, but do you think you should diversify it into other sectors to reduce volatility? So maybe you can let us know what's your opinion on that.
Right, I think chat. Okay. Okay, so sorry about that. We were just trying to look at the question a bit closer. So yes, there is always that question whereby, should I invest in tech? Is tech's valuation overpriced? Have I missed the boats on tech? Right, and then how should I diversify into other sectors to reduce volatility? So if you like how you're going to be investing within equities, right? That you probably shouldn't just be sitting on 100% tech ETF, right? Because tech alone itself is without a doubt one of the highest volatility sector there is out there. So to diversify away from this, then naturally what you could do, let's say within equities, you could look to add on perhaps say healthcare. Right, healthcare is emerging as one of the more anti-cyclical thematics that would benefit because of the current development that we're seeing in this pandemic. So aside from this, right, like if you're an investor and you know that you want to gain access to tech, and also you want to be able to diversify from tech, and you're not sure where to diversify, then I would say that the AutoPilot Kristal actually offers this kind of diversification. And alternatively, if you were to go on our Kristal platform and when you're trying to run the algorithm, you can actually state if you have any sector preference, and the algo would work with what sectors you prefer, and given the various parameters of what return you're seeking and how much risk you're willing to take on, then it's going to recommend you a portfolio that would, as best as possible, include tech and also a few other line items and investment vehicles that can help you diversify. So I think at the moment, if you were to run the algo and say that you have a preference for tech, right, then one of a few of the other diversifiers that you're going to be finding in this recommendation would be the BlackRock iShares short-term treasuries, because this has proven to be a good diversifier from the broader equities market. I hope this answers the question. Thank you for the question.
Okay, so one interesting question that maybe Hilda can get is, so what if I put in all my monies into equities? Would that be like, is it actually better to just put all my monies into equities?
I would say it depends on your time horizon. In the long run, for over 10 years, equities will outperform other asset classes, but before giving that performance, there is uncertainty and volatility. So you need to have time, which means you are absolutely certain that you have sufficient liquidity. And of course, having a strong heart helps you sleep better when your portfolio is down, say 20% in the downturn.
All right, thanks, Hilda. So let's just look at more Q&A that we can actually, so.
Yeah.
Mm.
Okay, I think we have this next question that I think is very valid and probably is top of mind after this presentation, right? Is that how often actually is the AutoPilot Kristal rebalanced and reallocated? And even for investors who do not wish to invest on the get-go $5,300 because that's the minimum investment size for the Kristal, right? Are there any way that we can gain this level of diversification, like sort of mirror the asset allocation of the AutoPilot Kristal? Or is there any way, essentially, to gain this strategy through a smaller capital allocation? So perhaps Thomas, our head of advisory, could help to answer this question.
Yeah, sure. Hi, everybody. So with regards to this question, the AutoPilot Kristal is rebalanced at a minimum on a quarterly basis. So as we have earlier shown in our presentation, that based on the back testing, we achieve optimum results if we do a quarterly rebalancing. That's also usually in the short cycles where we do see substantial changes to the model that then require us to adjust the allocation accordingly. It also, I think, goes into the philosophy that ultimately we're looking here for investment strategies, and too much trading in and out also causes a lot of friction, be it transaction costs or just like lost opportunities. That's one part. And I also want to take a look at a question that came from another guest to our webinar, and I think it fits very well into this thing, and I can also share a little bit into that, which is what is the model for the AutoPilot strategy, and whether it is based on valuation, market levels, or something else. So AutoPilot is following the same algorithm that we are using for our advisory algo. And we have previously also had a webinar on the algorithm itself. So for anybody who wants to go back, we have shared it on our YouTube page for you to catch up on that one. But just in summary, our investment algorithm is a genetic algorithm. So it is looking into the past performance of the underlyings. So it's using mathematical models to achieve the optimum return based per units of risk. And there's also a forward-looking component built into the algorithm, which is looking on specific asset classes and regions, which is built on the econometric model. So it's a genetic algorithm based on these two, but majority is based on data inputs.
All right, thanks, Thomas. Thanks for answering the question. It's extremely timely. Let's take a look at more questions that we can actually answer.
So we have also one interesting question about low interest rates and how does it mean, what does it mean for bonds as a diversification in the portfolio? Maybe Ashton, do you want to take that question? this is something also quite relevant.
Well, I mean, yeah, certainly I can take that question, right? So I think in the current environment that we find ourselves in, right, especially after this crisis, we see that US, which has kind of been like the last developed frontier of risk-free yield, right? And now that it's close to 0%, then as a result, that across IGs and high yields, you're going to see that it's going to track along that yield. And then the ultimate result from this development is that there is going to be the hunt for yield, right? And then the investment sentiment, it's going to be like, there is no better alternative to getting returns. And as a result, we have to invest in equities. And as much as that might make sense in the short term, given the level of support that we're seeing coming out of global governments, right, in terms of this fiscal and monetary stimulus. But it's like this system is currently living purely on the stimulus, and that because of this, that there might be other ramifications or repercussions somewhere down the road on longer term basis. And at this moment, I can't be sure, and I'm pretty sure most of the big banks can't be sure. And even Jerome, the Federal Reserve Chairman, Jerome Powell, has mentioned last night that there are going to be long-term repercussions from the current stimulus that we're rolling out. So I would say that it is always better, right, to have exposure to market, but at the same time, on an ongoing basis, I'm trying to rebalance and hedge out some of the risk if you're taking on excessive risk at the moment. Because like we've seen in March, right, that it doesn't take too much to collapse this house of cards in terms of the broader market. And right now, what we can focus on as investors is to articulate, right, what is the risk and return that we're comfortable with, right? If today we're only comfortable with making 15% and taking on 15% on the downside, then hey, go for a more balanced strategy, right? Let's say the all-weather strategy. You're gonna get 7% steady growth per annum with a very low drawdown.
All right, thanks, Ashton, for answering that question. Yeah, one question. Sorry. Yeah, so one question we got is CY Sun, he said like the idea of dollar cost averaging rather than a lump sum. But the problem is, what should he do with the high cash holding right now? And any place you can park the cash with some reasonable returns. So in sum, I think the question is essentially asking, so is it a good time to invest right now, or is it better to actually wait it out? So any of our panelists can actually answer that question.
All right, maybe I can take that question. So I would say regarding cash, right? So there are two parts to that question: whether dollar cost averaging still makes sense, and whether I should continue to sit on cash, right? So I would say, right, because of the topic of the webinar today is SIP, right? And you've brought up dollar cost averaging, that the only reason the only scenario that a monthly SIP actually loses out to lump sum and sitting on your cash is if on an intra-year basis, the market goes up on a monthly basis consistently, it keeps going up, right? But if you look in the past 20 years, right, at least at the S&P 500 index, that is, you're going to realize that over the past 20 years, right, that the only year that we saw that there were no significant intra-year monthly decline was 2017 alone. That is 1 year out of 20 years that doing lump sum would make sense. Thus, in the rest of the 19 years, having some form of SIP, be it monthly or quarterly, would have allowed you to average down at some point and meet better returns, right? So from this front, you realize that on a risk-adjusted basis, right, you're actually not sacrificing that much of your return, right? and you're actually getting a smoother ride with a more disciplined approach towards this. And as for the second part of the question, whereby you're asking whether, let's say, you're still under the mentality that perhaps you want to sit on cash first, and you want to know where you can park this at the moment. So with Kristal, we currently, for some of the clients that we have, for the AI clients at least, we have this Ariana Global Arbitrage Fund, but that actually has a minimum investment size of 50,000 USD. And that is a solution that we've recommended for investors to park their cash in to make some cash returns while waiting out. But
yeah, there's also one other thing. Sorry, Ashton, sorry. I thought you were done.
Go ahead, Thomas.
Sorry. No, sorry. Also, one other thing I wanted to highlight with regards to the cash investment. So we have, apart from solutions for accredited investors, we also, I think there are some fixed income instruments or bond ETFs that have a relatively low volatility. For example, a floating rate bond ETF that is not so much exposed to the fluctuations of interest rates and therefore relatively safe on that front from changes in rates. But the way how this can be managed is we are one of the few, if not even the only platform where we not only have a systematic investment plan, we also have a systematic withdrawal plan. So for investors who have invested, say, for example, a lump sum into a bond ETF and they want to shift this gradually into equity allocation, you can unsubscribe in regular intervals from the fixed income instrument and then reallocate it back through an SIP into equities. So that is the alternative to just having it sitting in cash for the time being, and to allow for a gradual shift of your reallocation over time.
Right, thank you, Thomas. So just one, sorry, don't mind. Yeah, so don't mind, just one question I have is, so why do we need to manage portfolio volatility as a whole? So I know this whole webinar is to discuss about portfolio volatility, but I understand there's a SIP, there's lump sum that we can do. So why do us as an individual investor have to manage portfolio volatility?
Yeah, I think in conclusion to that, I would say the key is really the drawdown. Yeah, so you want to sleep well at night, and especially for investing, the important thing is that we cannot predict at what point in time these drawdowns will happen. So when the market is going to sell off, and the worst possible time, or the worst is if you have to fall back on your savings, on your investments at a time when such a large drawdown has occurred, like what we have seen in March or in 08, 09. So that is kind of like the diversification objective is, first of all, to give you all a restful sleep at night, and also to protect your wealth against these drawdowns as and when they happen, that you preserve your wealth in a time when you actually need it.
Right, thank you so much, Thomas. That was a fantastic answer. So let's take a look at other questions that we can answer.
So I think one other question that we have from the audience is that you might have entered during the peak, and after the March sell-off, that you might have crystallized some form of loss, right? So to that front, I think I think our recommendation now, and the main topic for today, is that we want to be able to implement a disciplined investment strategy across, despite making a loss at the moment, right? So understandably, during market downturns, investors would be inclined to exit position, right? Because for the fear of volatility, and you want to avoid risk altogether. However, doing so actually minimize the opportunity for you to participate when the market actually recovers. So when stock market eventually recovers, then the investor will now be fearing that, oh, have I missed the boat on the market recovery, and is asset price too expensive right now for me to get into? Right? It's always going to be too high, don't get in, too low, scared, and you don't enter at all. So which is why so importantly that we are executing our investment strategy either through SIP, or if you have your own methodology, that there is a disciplined approach as to how we're actually executing our investments. And beyond SIP, like we've mentioned in this webinar over and over again, that diversifying across asset classes itself also helps to reduce the overall volatility.
Right, thanks, Ashton. Okay, so maybe one last question for our panelists. Apart from all the ETFs that we suggest, what do you think about adding properties as part of one's overall portfolio? So maybe any of our panelists can actually answer that.
So, yeah, I mean, property is an interesting asset class because it's, I mean, these are real assets, yeah. And what I like about property as well is, well, Singapore is probably an exception because market is very transparent in terms of prices transacted, and the volatility of property prices is probably higher than in Europe. But I would say there are investment vehicles where investors can participate in property investment. So REITs were mentioned early on, where the underlying is a property, but also for the flat. So for me personally, the property where I would be staying in, I wouldn't necessarily consider that as an investment because it's not something that I can liquidate as and when I want to, because I still would need to have a roof over my head. So it falls a little bit into a very different class. But for investment, I think the tricky thing with property is, while it's income generating, liquidity is a concern because it's not easy to transact. It's very expensive to transact. To introduce property as an asset class and diversification, a portfolio that is readily available, liquid, and low transaction cost, closest to get to is through REITs.
Right, thanks, Thomas. So we have come to the end of the webinar, and you can follow us on social media as such as weekly market updates, exclusive webinar highlights, as well as the investment tips. And you can find the webinar recording on our Kristal.AI YouTube channel, where you can click as the one in the circle. Yeah. Right, so thanks everyone for coming for this webinar. Thanks for making time, and we will see you real soon. And thank you for the panelists for making time to join this as well. Thank you, guys.
And
yeah, so if you guys have any questions, you can email us at you can email us at support@Kristal.AI. Let me just show you the link itself. Yeah, if you have any other questions, just mail us at support.Kristal.AI and we will answer them. Thanks everybody.
Thank you.